Well, welcome everybody, and thank you for joining us. My name's Jo Simpson, and I'm the Senior Development Manager at Eastside People, and I'm going to chair today's session. Before we begin, there's just a couple of housekeeping points. The first one being that we are recording this session, and we'll be making it available afterwards on the Homewards website and also the Eastside People website. There also will be some slides available as well, so things that you see today you will get sent afterwards. So you have that as a resource. We want to use the Q&A box today for any questions. So please do submit questions through the session, and we're going to break at a couple of places so that we can group them together and respond to them and give you a chance to get some responses. And anything that we don't deal with today, we'll endeavour to get back to you afterwards and respond to. It's going to click through. Before I introduce the panelists, I just wanted to provide a bit of context. So Homewards was launched by the Royal Foundation and Prince William with the one goal to make homelessness rare, brief and unrepeated. It's a 5-year locally led project across 6 regions or 6 locations across the UK. As part of the work, Homewards is basically securing a new source of funding and investment to help with the provision of homes and also the support required to end homelessness. Earlier this year, Homewards announced a partnership with Lloyds to support the 6 locations with the addition of Liverpool with an initial 50 million of new lending to deliver more homes to tackle homelessness. The partnership is recognised that some organisations are at different places along the journey to repayable finance. Some may not be ready yet to take this step and might want to have a better understanding of this area. So as part of the Lloyds commitment to Homewards, they are supporting this webinar for social and supported housing providers to understand what investment options are out there and how they might get ready to take on the investment. Eastside People are working with Social and Sustainable Capital to support Homewards and Lloyds with the initiative. We deliver a range of consultancy and recruitment services, including being excellent social investment advisors, and therefore that's why we're hosting the webinar today, and it's the area that I lead on for Eastside People. Thanks. Just a bit of context about our involvement with this. Overall, we support organisations interested in repayable finance to navigate this world. We go from initial introductions to maybe potential social investors and banks all the way through to supporting organisations with their due diligence. We're focused on supporting organisations to develop and grow through social investment. We often recommend that organisations use the Reach Fund, as this is a sort of grant fund pot that they can access that can enable them to draw down some funding that can enable them to bring people like ourselves in to support them with the bits that they need to do to show that they're ready to take on investment. So the kind of work that we do with that might be helping organisations with fit-for-purpose business plans, doing the financial forecasting and modelling, helping them ensure they can show they've got good governance, reporting on their social impact, etc. Through that, we've done over 50 Reach Fund projects, and those projects have secured 12.5 million in investment and donations. So we see this as a really exciting sort of piece of work for us. Increasingly, we're also working with clients who are able to fund this work themselves. So we're going to give you some introductions now to your panelists today. So from Royal Foundation Homewards, we've got Michael Corbishley. And from Lloyds, we have Steve Hutton. And they're going to chat to us about their partnership, what they're trying to achieve together, and the Lloyds funding offer. We're then going to have a little look at the wider marketplace. And we've got Annie Constable from Good Finance, who's going to talk us through the sort of resources and support that they're able to give. And then we've got Linda Wickstrom from Big Issue Invest, who are one of the leading social investors. And finally, we're delighted to welcome Darren Frost from Own Merit, who is going to be our case study today and talk to us about their investment journey and their exciting path to realising their investment ambitions. So first of all then, Michael, I'm going to hand over to you, and perhaps thank you very much for joining us. And perhaps you could just tell us a little bit about the Homewards initiative and where you see repayable finance playing a role in ending homelessness.
Thanks so much, Jo, and thanks everyone else for joining us today and the other panelists for making this happen. Jo's kind of set out really clearly kind of the Homewards mission in terms of demonstrating that together it's possible to end homelessness. And I think across the program, we have a kind of a range of different areas of focus, but absolutely at the heart of that is the importance of housing and homes. And we know that across our 6 locations, there are a range of different challenges and barriers that are preventing people from either developing new homes or bringing new homes to market. And one of those has been around access to different forms of financing capital. And so we were absolutely thrilled earlier this year to announce a partnership with Lloyds. We know that repayable capital plays an important role in the development and delivery of new homes in this country, and that anything we can do to make that repayable capital more accessible on better terms, or kind of more broadly available to different sets of partners, including some of those who might not have been active in this market. All of those things are positive things for us to do, and therefore repayable capital is one of the types of funding and finance that we're looking to leverage and unlock across our locations as a program, but plays an absolutely critical part within that. And so, oh, sorry, go on, John.
I was going to say, I just wonder if you can tell us a little bit about how you see that program developing.
Yeah, so I think one of the things that we have done recently is bring on some new strategic leads, including a new strategic lead around housing. And kind of one of the things that we're doing across each of our locations is trying to understand what the kind of the local ask is, or shaping the kind of the local opportunities, the local challenges. And we want to use that to really inform our work at a national level and the conversations that we're having with a range of partners about the different types of capital and the different structures and kind of resources and offers that we could try to then develop and bring to bear. And so the partnership with Lloyds is an absolutely brilliant start. I think it's a trailblazer for us as a program, and hopefully in the country. But we're also aware of the scale of the challenge in terms of homelessness and housing across the UK, and that there's kind of much more work to be done. So it's definitely the starting point for us then, rather than the culmination.
Great. Thank you so much. That was really interesting. Before we go any further and I introduce Steve, we were just going to have a quick look at this spectrum of capital, which we think gives a really good overview of, I suppose, the full range of, I suppose, organisations in the sector, and also those that are providing some kind of financing, and helps us orientate ourselves as we sort of move forward through the rest of the webinar. I guess there's a lot to take in here, and it just is a point at which I'll just remind you that you are getting the slides afterwards, so there's an opportunity to look at this at your leisure. But we're sort of making the assumption that people are quite comfortable with the kind of free finance grant funding at one end that might typically be a key funding source for charities, and then at the other end we've got the more traditional commercial lending with the sort of finance first. I suppose the bit that we're quite interested in today is this bit in the middle, the sort of social investment impact first bit, and there's sort of grades along that spectrum. So this tends to suit organisations who are obviously revenue generating, whether that's all of the revenue or parts of it. And so, you know, this is that they're then looking at the kind of repayable finance bit, which also has graduations. One of the things to point out, I suppose, is some of this might be pure loan finance, and some of it might be loan finance blended with a grant. So we call that blended finance. And also sometimes people might also combine it with an equity agreement as well. All of this being dependent on your corporate structure. I guess you can see at a very crude way that you've kind of got the commercial finance at one end, the pure grants at the other. So yeah, we're interested to look at something in the middle. And as we talk to Lloyds and also to Big Issue Invest, it'd be really useful to kind of hear from you where you see yourselves on this spectrum. Great. So I'm now going to hand over to Steve from Lloyds to also talk to us about what they do, why they're interested in homelessness, and yeah, how they see the partnership.
Okay, thank you. First thing I would say, it's nice to actually see that we've got 25 attendees on that, which gives you the indication that it's a subject of great importance. I think that really the sort of first concept that I would want to really get over in the conversation is how we are aligned with Homeward straight. First off, I think the key thing that we've actually got under our mandate and our sort of responsible growth purpose, it comes under the banner of helping Britain prosper. Our aspirations basically are to create and act as catalysts and create a more substantial and inclusive for all people and business, and doing that for shaping finance for good and for a force. So I think that's really important. Together with our group charity partners, Crisis, our CEO, Charlie Nunn, has called to action the UK to build more than 1 million homes for social rent. So we've got some very, very strong messaging out there with regards to that. With regards to our ambitions are very much in line with Homewards, where the principle of removing homelessness is very much aligned to what we're about and what we're trying to actually do. And that's why the initiative runs so well and so coordinated together. So I think they're really important. The other thing, which I think is extremely relevant, is that we're not just looking at the larger suppliers, we're looking at the smaller suppliers as well, the sub 3,000 units. And as quite rightly that Joe said, we are putting 50 million of new lending to support this. And so we are looking at actually pushing where we go. So that's the sort of things that we are looking at. Is there anything you want to raise with me at all, Joe?
I was going to ask you if you can sort of talk a bit about where you see your organisation sitting on that sort of financing spectrum, and why. Yeah.
Well, it's kind of interesting because I'm going to, from my perspective, I think the first thing that Lloyds, I want to get really across to everybody. Lloyds is a bank. It is. We run a team of relationship bankers. And it's really important to know that from a point of view that what we like to see ourselves is trusted advisors. Okay, from a point of view is that it's not just about lending, it's about working to find appropriate solutions and opportunities. And it is that bit where we communicate and we engage with people to see where the opportunities actually are and how we can actually support in a responsible way.
One of the things I noticed is that when you've announced the partnership, you're supporting the locations that Homewards had, but you also added Liverpool. I wondered why that was.
Yeah, it's interesting because my predecessor did an awful lot of work down in Liverpool. And I think that that's where it's all germed from. There's been some advanced working knowledge down there. And from a point of view, it is best to incorporate within. Because from my point of view, is that like a lot of these things, it's making the art of the possible and looking what we can actually do to support.
Great.
So that's why it's very much in there, an important part.
And then thinking about sort of, we probably see you more at the sort of finance first side of the lending. What sort of organisations do you see as being suitable to apply for the Lloyds?
Yeah, it's. I'm going to go. It's such a good question, and it can be an intimidating question at the same right as well. And from my perspective, and my background, when I actually have done some work with not-for-profit organisations as well, is that I'm going to harp on about relationship banking and trusted advisors and nurturing. Okay, the problem is that it's very easy to turn around being a big institution because it's sort of scary to knock on the door. So what we're looking to do is work with organizations to find the best solution to meet their needs. And, it can be blended, as you said, or it can be standalone. The actual fact of the matter is that the real skill in it is engagement with the organization. The real skill of it is understanding where the direction of travel and the journey actually is, and actually then providing a funding solution. And it can be bank finance or outside of that, as all blended, and turn around and look at the goals. So I've got a couple of examples just to sort of pitch in. If somebody wanted some long dated, i.e. a loan of say 25 years, we can actually look to do that. And that may be something in the goals of what that organisation may want, should I say, because they have a strategic view over a long period of time. If they wanted a shorter view, we can do shorter views. We look to actually support. I've got a case study that I would possibly look at, which is sort of Golden Lane housing. And again, this is where the due diligence and this is where getting to understand it means that you can provide an appropriate solution. And so the solution, we've actually provided some funding solutions for them. And I'm not going to make it more complex than this, but what it does, it provides funding for when they need funding. Not before, but when they need funding. So they actually only pay at the time that they're actually borrowing the actual amounts of money. What is it designed to do? It's designed to actually provide more units, provide more houses, so that if you look at the sort of mantra of what they are, which is, as you know, is trying to find a safe house, should I say, to actually allow people to be supported and to actually have independence, and I guess from a point of view dignity as well. So we can work on that. It's just really important to understand what is the actual requirements and what you're actually trying to do. One of the key pillars of what we say is the purpose of the borrowing is really important.
And do you signpost onto others if you find it's something that Lloyds can't do? Are you able to partner?
I tell you what, we have a bit of a responsibility on this, okay? And the responsibility is that where we can't do something is, well, first off, we try, we are very much impact first, right? We're impact first under the banner of being responsible, okay? And we are responsible in what we do. So we do at the appropriate level of due diligence and make sure that we do make sure it's the right solution for them, okay? Because it may not be always the right solution. I found myself when we actually discuss it, my view is that it's really important to give a way forward in a lot of instances, rather than just. And actually, I've just had somebody just pop in. I've got a relationship director, Toyin, who's desperate to actually speak. She's one of the practitioners in the team. Toyin, do you want to actually say something?
Yeah, sorry, and I didn't want to interrupt you. Good morning, everyone.
Morning.
Hi, Joe. So yeah, as Steve said, I work at Lloyds Bank, so I'm a relation director. I lead relationships with lots of our customers, but particularly around social housing. Some of you may recognise me from work I've done in the social investment space. So for the last 8 years prior to joining Lloyds, I was working in the social investment sector. And I guess I just wanted to chip in terms of there will always be scenarios for all funders in terms of whatever we can do in terms of finance. It might not be the right fit for the organisation. I think I bring the benefit to Lloyds of having worked in both sectors. So, and I continue to maintain my networking relationships. So if there are opportunities that are presented to us and it's not quite the right fit, I guess it's the benefit of knowing that there can be a warm introduction perhaps to an organisation we think can provide that support, or at least explore those options with you. And I think, the Golden Lane Housing case study is a great example of what we've done. I mean, they are a well-known organisation in terms of the housing support that they provide, very specialist, very people first. And we were very keen to work with them. And very much as Steve said, the funding facility we gave them, which we call a revolving capital finance fund, it effectively allows them to just draw the funds as and when they need them, and have that flexibility. So it suits their operating model, but also knowing that they have the backing of of Lloyds, and that we can provide that finance quickly as and when they need it. So it was an incredible opportunity to work with them, and having done that, we very much see there's the opportunity to work with more organisations. You don't need to necessarily be as big as Golden Lane. We can work with smaller organisations. Similarly, we have a huge social housing background and knowledge as well. So I think that engagement with Lloyds, it comes with lots of knowledge, lots of experience, and a real commitment to trying to support the housing need, particularly on the more challenging, more acute side of the sector.
I'll just ask a couple of questions. So I guess one of the first things that always seems to come up when we're discussing this is, what's the kind of interest rates that you charge? And also, I guess, what's the sort of other support that they might get from working with you as you go through this relationship?
Yeah, so I think we are, as Steve said, a relationship bank. So I
Mm.
think just like you would have a relationship with a grant manager at a grant funder or an investment manager at a social investment fund, we would work in exactly the same way. You do have a dedicated relationship manager that you call upon. I guess what we offer as a bank is a wider range of products and services as well. So the same products and services you would have with any bank, we offer that as well as any loan finance. In terms of pricing, I guess it is always dependent on what the ask is, and I think that's the case with social investment as well. There's always a spectrum of funding and finance. We are a larger organisation, I guess, and we have that sort of liquidity, flexibility that it gives us.
Mhm.
But it very much is, we would look at everything on a case by case basis. So I don't want to sort of throw out a number and be held to that, because that's not, I'd be doing everyone a disservice on the call. But we can definitely be competitive, and we have been in the
Yeah.
past.
Let me just
Is there a number that you'd, when you talk about small to medium size, is there a sort of a turnover that you would use as a minimum and a top?
Sorry, Steve, I didn't know if you wanted to come in then.
Yeah, I can come. There's a couple of points that I just want to actually endorse from what Torian just said as well before I actually answer the question, which is that we will look at things, because it's one of the key banners under Help and Britain Prosper. That's something that we would look to price competitively, or compellingly, should I say. So I think that's really important. With regards to any form of standard metrics, we would turn around and we would say turnover, we would be looking at about £1 million turnover. But from a point of that we would look to have some sort of tangible security as well in the background. So, but from a point of view, we would assess it on a basis, again, working with people just to actually fully understand, because we do have the responsibilities to make sure that we are lending in a respectful and responsible way.
Great, thank you. Thanks both of you. That was really, really helpful.
No, could I just interrupt? Sorry to say, we have a few questions for Lloyds. I'm just saying we will have a break for questions shortly, won't we? When the panelists have all had a chance to speak, yes. And then we'll try and summarise them and field them back to the individual presenters. So just to let people know.
Thanks, Tracy. Lovely. Right, we're now going to move on and thank Annie for joining us. So Annie is from Good Finance, who have that unique, I suppose, position of being able to have an overview of the sector, because they are able to provide resourcing and other information relating to social investment. So perhaps Annie could tell us a little bit about Good Finance, what it is they do, and how they came about.
Yes, of course. Thanks, Joe. If you could just go to my first slide, that's brilliant. Thank you. So yes, we're Good Finance. So our mission is to help charities, social enterprises, community organisations to navigate the world of social investment. We're a collaborative kind of independent autonomous project. We're jointly funded by Better Society Capital and Access, the Foundation for Social Investment, which are both wholesalers within the social investment sector. And our goal really is to provide as much information, tools, resources as possible to as many people as possible, to better equip users to build knowledge and kind of make those really informed decisions about whether or not social investment is an avenue worth exploring for their organisation. So, we're certainly not here to say it's the best thing since sliced bread and everyone should do it, but we really want to provide that information and equip our users with everything they need to kind of make those informed decisions. So that's who we are and what we do. If I just cover some real basics about kind of what we perceive social investment to be, to get us going. So we kind of define social investment as the use of repayable finance to help an organisation to achieve its social purpose. And I think what's really important to say here, it's definitely not a one-size-fits-all solution, and it's not the be-all or end-all. So usually it would sit alongside other forms of income, such as kind of donations and grants, trading, contracts, payment by results, perhaps within the homelessness sector, kind of rental income, as well as other forms of finance from banks as well. I guess there's a few kind of considerations that we usually advise organisations think about before they look into social investment, and that's what do you need the money for? Is it to buy an asset, or other kind of reasons might be to grow and innovate the services to increase the impact that you're able to deliver, or maybe it's just to maintain your cash flow and make sure that you're kind of meeting those monthly bills on an ongoing basis. The second one is, do you have a profitable income stream? So I guess, spoiler alert, if you haven't got that trading income or the ability to repay a loan with interest, social investment probably isn't the right avenue for you to be exploring right now, but it is something to keep in your back pocket for the future. And again, that profitable income could come in the form of rental income, membership fees, contracts, and some social investors will consider kind of donations and donations and grants as part of that as well. And then the final one is kind of what impact will you create? So going back to that kind of initial spectrum of capital that we saw earlier, that's what really sets kind of social investment aside from the more mainstream financiers, is that they really care about the difference that that money is going to make. And once they kind of go into partnership with you, you're kind of working together to achieve that kind of same shared goal. And I think that's really important when you're working so closely with someone for such a long period of time, on something that's so integral to your business as well. Sorry, Jo, did you want to come in there?
Thanks, Annie. I was just going to say, do you want to talk us a little bit about some of the tools and resources maybe that you guys are able to offer?
Yes, of course. So as I said, because we are jointly funded by kind of Access and Better Society Capital, everything on our website is completely free and available to everyone at any one time. So I'm certainly not trying to sell anything here, but we have a range of online tools such as the Is It Right for Us tool and the Outcomes Matrix. We've also got a cost of capital calculator, and all of these are available online, and they are designed to help you at whatever stage you are at the journey. So Is It Right for Us being right at the start, and then that cost of capital calculator coming when you're starting to speak to different social investors and getting those different offers for deals. Case studies. So we have over 120 published case studies on our website now, and that's examples of social investment in action. We're told time and time again by our users that these are such an important way of seeing how it works in practice, and just seeing how an organisation like yours has been able to secure social investment and what they've used it for can be really, really helpful. And we also collect 5 key pieces of information here to give the true and real transparent picture, including the cost of capital rate, the term of the loan, the turnover of the organisation of the year they took social investment, how much social investment they took, and what product they took. So you really should be able to get the full picture through those. We also have a couple of resource hubs, so anyone looking particularly for energy resilience, perhaps more relevant within kind of anyone in the housing sector. And then we also have a pre-investment support hub as well, for anyone who's not quite ready to take the leap with social investment but is looking for kind of free signposting to resources that can help. We have a range of blogs and podcasts and tools, and all of those kind of feature people that have been there and done that with social investment, and we ask them to share their warts and all journey. So again, another good way to hear from people who have been there and done that and got the t-shirt. And then finally, we've got a couple of directories. So these are our most used tool within our website. We've got a social investor directory, which lists over 100 different social investors and funds across the UK. And you can also filter your search by the amount you're looking for, the social issue you're trying to tackle, what type of capital you're looking for, and location. And that should narrow down your search and provide you with an investor that's really aligned with your organisation as well.
That's brilliant. Thank you so much. That's really useful. That's just a quick kind of nudge to me to remind everyone as well that all this information and resources they will see in their slide pack that they'll get afterwards. And there'll also be, you'll be able to see the slides from everybody else as well. And I think we've also got some kind of named contacts and resources for people to check out in the slide pack. So thank you so much. I guess the last bit I was just going to ask you was around any top tips that you might have for people who are thinking about entering the market.
Brilliant. Thanks, Joe. And yeah, so we often, obviously, we spend a lot of time speaking to organisations that kind of exploring social investment. And then once they kind of go through the process, we ask them kind of what they learned or what they would provide to other organisations in their position. So this hasn't come from us, it's come from them. And so the first one is social investment is not benevolent money. It's really important to set it aside. It's not a grant. It is money you have to pay back with interest. And it's good to get that kind of clear and upfront right at the start, so as not to waste anyone's time or your own time in trying to explore something that's not quite right for you. Impact matters, so that's what really, as I said, makes the difference between mainstream finance and social investment. A social investor really cares about what difference that money is going to make for your audience, and they will help you to grow that impact as well throughout the process. It's about much more than just the money. So we're often told of the kind of benefits of a social investor is in that partnership. So you're not just talking to someone that doesn't understand the sector. You're not just talking to AI. In some cases, you get a dedicated relationship manager or investment manager that understands the social impact sector, knows what you're going through. And actually, a lot of the time, social investors are in fact social enterprises themselves, so face very similar challenges. And they can provide a lot more of that holistic support if they deem that to be required as part of the deal. So it's not just here's your money, there you go. A lot of the time, there's also kind of mentorship, coaching, or extra business support and other opportunities flagged throughout that process. Honesty is always the best policy. So we often get asked what happens when things go wrong. I had one person that said, I thought my investor was going to come in and start tearing tellies off the wall. It's certainly not the case. And, we always say if anything's looking like it's slightly going south or things aren't quite going to plan, the first port of call should always be your social investor. Pick up the phone and let them know the situation. As I said, once you're working together, it really is a shared objective and goal that you're trying to reach, and you're on the same team. So honesty is always the best policy there. Why isn't it cheaper if it's social? So again, this is a question that we get quite a lot, and sometimes it is cheaper, sometimes it's not. What we do say is a lot of the promotional rates that you see in perhaps some of the more mainstream finance providers aren't always what you will end up receiving, as social enterprises and charities are typically deemed more risky. But yeah, essentially where the interest rate comes in is where that social investor gets their money from, and that will determine the price along with lots of different factors. And that's why we always say it's worth shopping around and doing your own due diligence on which investor you'd like to work with in the future. Due diligence isn't fun, but it does make your business better. So we get this a lot. We've actually only found one person that's ever enjoyed the process, and that was someone in Nottingham. I don't know what's going on there, but it really does give you more confidence in your business plan, the future of your organisation, and the impact that you will ultimately be able to achieve. Lots of people say it's, it is quite a difficult process. You've got something that you're really passionate about, and someone coming in and essentially kind of really stress testing it or picking it apart. But I interestingly heard from a social entrepreneur, Sebastian Rocker, the other day, who provides housing for LGBTQ plus refugees. And he said he had to reframe it in his mind to embrace scrutiny. So I thought that was worth sharing as well. Embracing that scrutiny really changed the game for him. And then finally, it always takes longer than you think. Again, this is something we hear at Good Finance quite a bit. It's certainly not a quick fix, a kind of emergency finance solution. What we would say is, again, going back to being honest and upfront with your investor. If you know that you've got a timeline or you need that money by a certain date, please do let them know ASAP so they can provide kind of honest and open kind of timeframes and whether or not that's going to be possible in the first place. But typically, cycles can take anywhere between kind of 9 to 12 weeks all the way through to kind of 9 months or even more than a year for slightly more complex deals. So it's just worth remembering it can take longer than you think.
Great, thank you so much. That's really, really useful. And yeah, I can't second enough the importance of the due diligence bit. And again, I think we talked about the Reach Fund earlier, but we see that quite often there is a big gap in terms of what people might present with and say, well, we've got our forecast and we've got our business plan, to what is actually being asked of them so that someone can make a really good decision about lending them money. So that bit's very critical, if not sometimes a little bit painful. And even if you don't end up securing or deciding to go for social investment at the end, you will definitely leave your business in a much better place and be much more informed than you were at the start. So it's a valuable process no matter what. So yeah, that's great to highlight. Thank you. I think we are now going to hear from Linda, Linda Wickstrom from Big Issue Invest. So she's going to tell us a little bit about the funds that they have and where they sort of sit on the spectrum of lending. So over to you, Linda. Thank you.
Hello, hi there. It's lovely to be here. Yeah, I'm an investment manager at Big Issue Invest. Yeah, I guess to answer your first question there, Joe, in terms of where we sit on the spectrum, I think we probably sit, I can't remember if it's left or right, but certainly working with organisations that are either registered charities, KICs, community interest companies, or sometimes also impact first businesses. But as an investor, we only invest in those organisations that intend to have a social impact, and where that is sort of front and centre of their mission as an organisation. So we, I think, are one of the oldest social impact investors around. We've been here since 2005, so we've been doing this for 20 years now, and have invested around 100 million since then. So we've got a fair amount of experience in the sector. But so yeah, we tend to work with some really small guys, a turnover of maybe somewhere between 50 and 100,000 a year, and providing some small finance from maybe about £20,000 for them, up to larger national organisations where they need millions. But we really try and focus our investments on high deprivation areas, with diverse founders as well. There was a report that came out a few years back that really highlighted the need for investment going into diverse-led organisations that are really solving some of those, equality and diversity questions. So we have funds that really focus on that as well. And to sort of, I think, Steve and Toyne's point earlier as well, we really focus on that sort of building that relationship, and working with organisations on a really bespoke level. So I, as an investment manager, will, sit down with an organisation and work through their individual case. It's not like you will fill in an application form, it goes off into the ether, and then you'll hear a yes or a no. You will hear from me, and then I'll work with you to sort of almost peel back like an onion, layer by layer, sort of, and hopefully understand whether we are the right fit from you from the start. And if we are, we will kind of peel back the layers further. And that's how we sort of approach our due diligence, and we'll work with you that way. And then, working with you throughout the investment as well.
Great.
And that, I thought, shall I go through some of the types of investments we can
Yeah,
make?
that'd be great. It'd be great to understand a bit more of the type of funding, and also who might be suitable to apply for funding when people are starting to look about. We talked a bit about, I think, Annie, you said about sort of think of the marketplace as a marketplace, and that people should shop around and try and understand the different people that are in that. So look at the chemistry and look at the different offers, and yeah, find the right fit. So it'd be great to hear about that.
Yeah. And maybe just to mention as well that, we're part of the Big Issue group. Maybe I'm sure a lot of you will be aware of our magazine. We are a social enterprise ourselves. So yes, we're trying to apply that experience of what it's like to be in the sector ourselves as well. But so I'll talk through mainly sort of the loan side. I figured that might be most relevant here, given it's a housing and homelessness sort of themed webinar, but I'll touch on the equity and revenue share investments as well at the end. So when it comes to kind of loans, we offer as little as 20,000 up to 3.5 million. And we do secured and unsecured lending. And I guess interest only periods are available as well, to kind of help organizations perhaps at the early stage of a loan, where you're trying to get things up and running, or or that period where having all the capital in your bank account is helpful. We We do fund a fair amount of things that banks will not fund, but I should also say that we work a lot in partnership with banks. So when it comes to property deals, for example, you may find that a bank has a threshold in terms of the loan to value on a property that they will lend. If they will lend you, say, 60%, but you only have a 10 or a 20% deposit, we can come in and top up so that you can get to the amount that you need, and often take a sort of second charge behind a bank to kind of support on that basis. We also have a fund that really focuses on property-backed lending, where we can lend up to 3.5 million and with a loan to value of up to 90%. And that is really meant to be a fund that supports organisations, especially in the early days and often more risky days of a project. So whilst we don't tend to, have long loan terms of up to 25 years like a bank do, we will typically lend you money for about 5 years. We can do an amortization schedule that is a profile of over 25 years. And then we will work with, say, a bank to, at the end of the 5-year term, you will have paid down a certain amount on your loan, which means that it's perhaps more, then becomes a better fit to work with a bank who can provide you with a longer kind of term and a more of a mortgage style loan.
Could you explain a bit about the flexibility that you have with some of your loans, so the flexible terms?
Yeah, absolutely. So as I mentioned, we've got interest-only periods, and actually most organizations find it useful to have that at the beginning. They might be ramping up a project and aren't quite ready to start paying from day one. But also as a social investor, we are patient, and that takes a lot of that works in a lot of different forms. So we are there as relationship managers to work with you, and sometimes actually we provide sort of quite bespoke repayment schedules. It can be bullet payments if you are paid by upon the sale of a property, or whatever those look like. So your repayments may not be just the same amount every month, so that can be something that we support with. When things get difficult, we are there. As I think Annie said earlier, we are not there to tear down your TVs off your wall. We will work with you to find a solution, and as she also said, it's so important that organizations get in touch as soon as they see a challenge on the horizon, because we will do everything we can to work with you to find a solution, including providing sort of repayment breaks and things like that, in order to kind of support you before it gets to the point of repossession any property or anything like that.
Great. I was wondering as well if you could perhaps touch a bit on the Reach Fund, and I suppose maybe the role that you see that having and how that's been a tool for the sector.
Yeah, the Reach Fund is absolutely great. Actually, we know that a lot of organisations, especially in smaller ones, people wear a lot of hats and don't always have a lot of time to work on business plans or cash flows and forecasts. So we will typically ask for a forecast of at least 3 years into your future. And if that's something that you don't have and you don't have a business plan to go with that, then we refer to the Reach Fund, where you can get a grant of typically up to 15,000, but I think in some cases even more, to go towards having a consultant, usually a consultant, come in and kind of work alongside you to help you build business plans, to build forecasts, but also sometimes to help with legal costs that might be prohibitive as well. And we will also, sometimes that fund also pays for you to get a backfill. So if you're the best person in your organization that's best placed to do these forecasts and things like that, but you have other day responsibilities, and you can just use the funding to get someone to get a backfill for those responsibilities.
Brilliant. And just to add to that, we will be sharing a link to the Reach Fund in the resources bit that will go with these slides, so that people can check that out too. Thanks very much. I think that's everything that you had to cover. So we might.
Well, shall I very quickly cover on, I guess, the equity and revenue share piece? Would that be
Yes,
helpful?
yeah, no, that would be interesting. Thank you.
So equity and revenue share is obviously, so equity is for organizations that are shareholding, and where we will come in and take buy shares in your organizations. It tends to be even more patient than our loans. It's there for organizations that are typically in a high growth scenario, but where that growth may not be realized until 12, 18 months down the road. And where therefore, instead of having a sort of set payment every month that you need to get through, obviously the payment through an equity or a revenue share investment tend to be linked to your performance. So it's more patient. It's there for organizations that are really ramping up for growth, need investment to fuel that growth, and who have a really quite a unique idea, trying to break into new areas in the market and so on. So we have investments there from around 200 up to 700,000 as part of our, I guess, call it impact VC venture capital. And revenue share is for organizations that don't have shares, who are companies limited by guarantee, for example, but it mimics the way that equity investments work, in that we take a share of your revenues or your profits. Yeah.
Great. Do you have a sense of how many sort of deals that you do each year?
Wow. Yes. I mean, we have a couple of different teams. I mean, in my team, I work on the slightly smaller ticket sizes of up to about 400,000, and we will probably get through 50 to 75 deals in a year. Whereas our larger ones, maybe 2, 3, 4 in a year, in the millions. It depends on our equity side. Probably about 10 or so a year, 10, 15, I think. Yeah, and as I think Annie said, it can take a little while, and obviously if it's a larger and more complex deal, then more expectations around the due diligence process will follow, as well as expectations around taking security. But absolutely on the smaller end, we try and keep it as light touch as we can. We know that organizations are strapped for resource, and we certainly don't want to make you kind of give us more than we actually need. So we try and be as bespoke as we can, and ask for kind of documentation that's specific to the situation that you're in.
That's great. Thank you. Thank you all very much indeed. I think we're now going to just take a break here and have a look at some of the questions that have come in on the Q&A. Tracy's very kindly been grouping questions that are similar, and I'm going to hand over her to walk through the questions. She's going to read them out so that we obviously capture what that question is for when people are watching afterwards. So I'm going to hand over to you, Tracy. Thank you.
Thank you, Jo. So Declan had asked, I think we maybe have answered this, about what the rates of interest and LTV levels are in your lending. This was for Lloyds. And is this negotiable based on individual organisational needs or size of loan? And I think we touched on that sufficiently. So I'm hoping that we have answered that question for Declan. But do you want to just, Steve, do you just want to, for the recording purposes, do you just want to re-answer that perhaps, please?
I mean, from a point of view, we will look at compelling rates from a point of view because of where we actually stand as one of our key pillars in our sort of strategy. So we will make sure that we do due diligence to make sure that we actually price out appropriately, and we do offer very favourable terms. And I've been involved in a lot of those negotiations. So yes, we can look at that. LTV, we would look around about sort of 60%, as I've already indicated before. We tend to look at these sort of things on a case by case basis, as Toyin had said earlier.
Yeah, thank you. So, and there was a question about the minimum size of organisation that it would have to be to access the offer. I guess we're talking specifically the offer that we have with Homewards. So, if they had a small number of units, would that organisation be eligible?
Mm-hmm. The eligibility criteria, what we do is have probably a triage call prior beforehand, just to make sure. It's very difficult to actually turn around because we have to look at it on a case-by-case basis. And so from a point of view, I don't really want to go. There are sort of minimals,
I think they're set out, aren't they, on our slide? Yeah.
Yeah, they are minimal, but we're, from a point of view, is we're open to offer a little bit of guidance where appropriate, and we look at it on a case-by-case basis.
And I guess sort of linked to that, we should say that in the contact and resources section of the slide deck that you'll receive, there is a contact to make a specific inquiry about the Lloyds offer. So you can always direct your queries through there. And then the other question we have, and the last one for Lloyds, was homeless prevention organisations that don't currently have properties, would they be eligible in any way for the funding that you're discussing here?
Toyin, do you want to cover that one, or shall I?
Yeah, no, I'm happy to cover that one. So I think a key thing for us, as I'm sure it will be for all social investors also, is track record. So particularly where we're looking at finance for housing, for properties, the track record in terms of having managed, owned, sort of dealt with some of the complexities that come with being a landlord will be really key to us. So hopefully that kind of gives a steer. Track record will be quite a key part of it in terms of just that ownership piece. So yeah.
Thank you, Tom. And I guess I had a question, which was a sort of group question for all the panelists. I'd be quite interested to hear from everyone, which was really around risk. So we've talked about risk in relation to probably, I guess, raising funds for investment funds, but then judging that in terms of the price of the money, but also thinking about risk from the point of view of the organisation, maybe how boards react, or the concerns that, particularly in a charity, for example, maybe a trustee board might react to risk. Or so, just interested for each of the panelists, I guess, to talk about their experience of risk in this space.
Yeah, I mean, I'm happy to go first. So I guess my career has seen me experience working across the whole funding spectrum, both with grant makers all the way through to mainstream lenders, and kind of risk always underpins a lot of those discussions. I think a key part of how I work and many of the organisations I've worked in is around that relationship piece. There is always an understanding that borrowing repayable finance is something that needs to be considered at all levels, both at management, but often with the board. And a key part of that is a lot of engagement. So we absolutely understand that there'll be lots of questions and there'll be queries and there'll be things that we just need to reassure and cover. And we want to ensure that as we enter into those discussions, there is 100% clarity on what is being considered, the finance, the terms of it as well. So everyone is transparent about all of that. And I think it really does vary. So I've worked with some small housing associations this year to secure some finance. And even with their sort of 50 years of experience in terms of what they're doing, there were lots of questions and lots of things that I needed to cover with the board, with the trustees, just to get them comfortable as to what the terms of the lending are. So I think it very much is seen as a relationship lend. We're going to go with any of the organisations on that journey through the due diligence process and try and provide as much clarity as possible. And as part of that, we recognise that that's going to help address any risk concerns that we have. From sort of my perspective, my peers, the teams that Steve manages, we need to satisfy our credit teams, and we do that by knowing that we've asked all the questions, we've built that rapport, that understanding of how your business operates, understanding of what your challenges are, sort of the day-to-day mechanisms of it, contracts that you might have, all of that. And so that we can, from our perspective, understand whether, again, is it a good fit? And if it is, how do we then ensure we convey that in the best light possible to get a positive outcome?
Thank you, Toyin. Linda, Steve, do you want to?
Yeah, there's a lot to echo with what Toyin said. There is a couple of other bits that I would like to add. I think as well, I know I want to fully, there's three parts to it. The first one is the due diligence is obviously really important for all parties, so everybody completely understands exactly where they're at. I think the second point, from our point of view, is acting as a responsible lender. Nobody wants reputationally to actually be making incorrect decisions. So from a point of view, we do the due diligence not just to protect the organisation, but to protect not just to protect the bank, but to protect the organisation as well, because that is that level of responsibility. And then the third part is if we get it right, we can replicate it out. So we become a bit more of a catalyst. So there is an awful lot to be said for we actually do share the risks as well as the organisation. And I think people, need to actually see, because what we are trying to do is we are trying to be force for good. We're trying to grow our commercial book in an appropriate way. We are trying to actually add back into society. So there are the sort of considerations that probably need to be sort of highlighted as well.
Thank you, Steve. Linda, do you want to add anything to that from your perspective?
Yeah, I mean, there's lots of angles to this, I guess. Absolutely, trustees or directors, non-executive directors need to be engaged. We work with a lot of organisations where they've never taken on a repayable finance before, and we want the board to understand the risks and that they are on board and supporting the management team, of course. But I guess another angle around kind of managing risk, I think, is also thinking about actually, how can you share the risk, not just amongst also as an investor, we are there to take risks, and actually big issue invest, we tend to work at the riskier end of the scale. And we have some, Annie mentioned the foundation, the Access Foundation, and there's government supported funds that come in through ours, and we are here specifically to take high risks and work with organizations that have riskier proposals. And so from that perspective, I think you mentioned pricing, etc., Joe. Our pricing doesn't necessarily follow your traditional sort of commercial pricing structures. Sometimes, we are here essentially to take risk, and so our pricing is not necessarily always more expensive because you're a riskier proposal. But that's why we're here to do. But I'll give an example. I'm working with an organisation at the moment who is really keen to open a co-working space, and they are working with a landlord, and they're asking us to take the risk in investing into this. They need to kind of have some money for cash flow up front to make this co-working space work. But actually, sometimes you can think about sharing risk. So I've encouraged in this situation actually to consider, is there risk sharing with the landlord that's available? Because in this case, the landlord would take quite a hefty kind of rent every month. And we've said to them, well, actually, us as an investor cannot go in and risk all of our capital. Neither should you as a small social enterprise trying to run an inclusive co-working space. Can you ask the landlord, who happens to be a very large, multinational corporation, and can you share risk with them in terms of some sort of revenue share agreement where they only pay rent in months where that kind of agreement, and actually think about how can you spread risk as widely as possible, and social investors will look favourably upon that.
Thanks, Linda. I have one more question, but I want to just go to Annie just to see if you have anything you'd like to add, Annie.
On the risk front, I don't think so, other than kind of echoing what's already been said, and obviously reiterating that every investor will have a different appetite for risk, and that's dependent on a multitude of factors. I guess the one thing I would say is, on a bigger scale, if we look at an example from the sector recently, so when the pandemic happened in 2020, and obviously overnight lots of things changed, I think that's a really good example of where the social investment sector as a whole were able to actually look at that risk but diversify really, really rapidly and provide repayment holidays, flexible terms, kind of overnight to support those organisations. So just another example of where they're slightly different to perhaps some of the more mainstream lenders.
Yeah, thanks, Annie. I'd echo that. I was running I was an investee, in fact, I was a big issue investor at the time, and we were in that position in COVID, and it made a massive difference to have the flexibility there with all of the sector really to support through those times. One last question for Steve. So how is Lloyds approaching the challenge of assessing ability to repay in its social investment lending model, given the inherent unpredictability of income streams in many charities, particularly those reliant on grants, donations, or public contracts? And therefore, what adaptations are you making in your standard lending criteria to reflect this reality?
Good question. It's a good question, and from a point of view, you turn around and say, how do you actually lend to a non-for-profit? Because a non-for-profit, in essence, doesn't make a profit. So how does it cover debt serviceability? It's really so. The key is in a lot of this is actually how you get comfortable, because it's working out. The question is geared on donations and revenues in, but sometimes it's also working out what the actual are fixed costs, what are actually discretionary costs. So from a point of view is that what is a, dare I say, I don't want to get into technical banking, but what is a balance sheet play? In other words, are people actually are making more costs through choice? So it's from a point of view, it's getting comfortable with the assessment. It's getting comfortable with the funds coming in. Are they restricted or unrestricted funds? Are the costs discretionary, or are they fixed costs? All it is understanding the root cause of it, because we've got the capability to actually understand what the actual needs are. And we just got to turn around and say, right, we just got to normalize it to make sure that we actually fully understand what the actual risk is we're taking on. So it's not standard credit policy where you turn around and go, it fits or it doesn't fit. It's very much bespoke.
Thanks, Steve. Jo, we're 1 minute beyond our deadline, but we're not doing badly. So
I think that was worth it, because that was really useful, and I think it really brought to life some of the variation as well. So thanks everybody for that. Right, we're going to just finish off with our final panelist, and I'm delighted to welcome Darren Frost from Own Merit. So this is basically Darren's going to talk to us about Own Merit, their story of how they came to be, and also what their investment ambitions are, and how they've got to this point. So I'm going to hand over to Darren. Thank you.
Hello, everyone. Sorry for the name Dawn Frost. It's Darren Frost. So our investment journey, it's been a bit of an interesting one. So Own Merit CIC, our name comes from a tragic event. I was involved in a terror incident on London Bridge in 2019, where sadly Saskia Jones and Jack Merritt were killed. But at that event, something remarkable happened. Was two prisoners also joined in the fray and helped to save lives. They worked alongside me and they put their lives at risk. And this really cemented a belief I had already held, was that we keep viewing people for their earlier actions and not seeing their potential. And there was a Dr. Ruth Mann who used to do evidence-based practice at the Ministry of Justice while I was working there. And she used to keep talking about how to get the best results and change people's behaviors. And it was about treating them humanely, in implementing procedural justice where things were fair but firmly applied. And so I took this methodology and tried to apply it to housing. So we put together a model explaining how we believed it was safe to have up to 6 prison leavers running a house themselves and living in it without any staff on site. The authority thought this was absolute madness. They said having 6 prisoners unsupervised would become a university of crime, and it would be absolute chaos. We couldn't get any funding to start this because people thought it was an impossible thing to do. But here we are 2 years down the line. I decided to self-fund it. And my business partner is Steve Gallant, who helped me on that day on London Bridge. He was convicted for murder, served a life sentence, or is serving a life sentence. But however, he also got the Queen's Gallantry Medal and Royal Prerogative of Mercy, so Queen's Pardon. And together, him and I opened a 6-bedroom place 2 years ago. We were losing money in the beginning because we ramped up really slowly. We had to empty a house and HMO. But 2 years on, we have housed 20 men. We've only had 3 reoffences and 4 recalls in that time, which is about a third of what most providers seem to get, and we haven't had a single incidence of violence in the house. Probation service absolutely love it and want to, we're oversubscribed, there's so much demand, and the council are asking us to look at doing this for their care leavers who've been in prison as well. So very exciting times. We were featured in a news article in The Guardian, and that's when we were very, very pleased to have Big Issue reach out to us and say, is there any way we could support you in this and look at growing your model? That was about a year ago. And so we went to Big Issue's offices in London, and it's been an absolutely incredible journey with them. We found a total different environment to any funders that we'd met before, any banks that were offering mortgages on HMOs, which can be quite challenging. And we were able to, with the support of Big Issue, access the Reach Fund. And the Reach Fund put us in, or through that, we were able to work with Eastside People to have a look at our business and our model. We're trying to be very different. We are trying to break out of the enhanced housing expensive rate that everyone else goes for. The biggest issue with enhanced housing, and most people aren't aware of this, is that if you're in supported housing, it's basically impossible to get into work and break out of that cycle of dependency. It is the biggest modern day error or crack in our housing system, is that we put people into supported housing and we believe that that's a good thing for them. And while some people need that, actually they need to be helped into independence, and supported housing doesn't allow for that. And it's all about the funding models. So the local authority pays for that housing, and if the individual gets into work, the local authority isn't able to claim the rebate from central government. So that individual is expected to pay up to £400 a week to stay in that place. So they have the choice, either work or be accommodated. So we have managed to do this for the last 2 years using universal credit alone. And it's been very challenging. And through the work that we did with Eastside People, we realized they looked at our models, at our funding. They said it is sustainable. However, to grow, we need more income. And so we're trying to do a hybrid blended model of 1 to 3. So one house within the supported housing, and then 3 houses, which would be on our model. And the supported would kind of help us balance the model. Big Issue's been wonderful. Originally they were offering us up to £200,000 towards purchasing of properties so we can expand. Our challenge is that in Northampton, for an HMO to make it scalable, we need a 5-bedroom HMO, and most of those are about £300,000. So we've got £100,000 shortfall, which is prohibitive for us. There were some interesting things, though, that have been proposed. The rate was at 8%, which is quite high, but 20% of that would be a grant. So that brings down the effective rate to about 6.4% for us, which is slightly higher than an HMO, but with the flexible terms, it is an absolute gem for us, because it means, well, there's a lot of things. One, Big Issue was saying that they could work with us, and if we only got up to 15% deposit, that is huge compared to the 25% normal lenders would require for an HMO. In the beginning, they were talking about us paying back the full loan within 6 years. With our income, that just would not be feasible. So they went back and readjusted, saying, okay, well, we are able to offer you interest-only portions, but interest only with a bit of capital, so that over the 6 years, you paid off enough to be able to remortgage through traditional methods. That is incredibly generous, but also works with us and understands our position. And then there was also something that was really, really exciting, is that they offer an option to repay early with no early exit fee. Like, these terms are all really wonderful for a small organization that's looking to grow. It takes away a lot of the prohibitive issues. there's also something that can't be underestimated, which is when you go through traditional mortgages, you have to pay arrangement fees. And so there's none of these oppressive fees and all the rest. And Big Issue really want to work with us to solve this issue of prison leaver homelessness. Um, we've we wanted to be responsible partners within this. We didn't just feel like a client, but we felt like we feel like we're on a journey together. And so we decided not to take the funding yet because we were having some really positive conversations with the council and they were looking to invest in us anyway. And those terms are even better still because it's the local authority and we're doing a service for them. However, we've just hit a bit of a snag. Locally in West Northamptonshire, Reform have taken over and they're sending in the DOGE or DOGE, Department of Government Efficiency. And even though we are very efficient in our model and would save the council a lot of money, they still have to go through these processes. So we've hit a bit of a snag, but very excited. I think this program between the Reach Fund, the support from Eastside People, and the partnership with Big Issue is just unbelievable for a small organization which has such big impact.
Thanks, that's super useful. I think you highlighted something as well that's important in that role, I suppose, of social investment as the input at the start, which maybe then opens up the potential to go to a broader range of lenders later on down the line once you've kind of proved the case and you're up and running.
Yeah, I think that it was really useful to have that reflection and overview of our business because I think Annie was talking about it before, people wearing many hats. Well, I'm founder, I'm social worker, I'm landlord, I'm accountant, I'm everything. And accountancy is definitely not my strong point. I can work with people, I can have the impact, I can make the books balance, but understanding all of the finance is not my strong point. So I think that's where it's been really helpful to have external guidance, but also what we found out through, well, what we worked out through the support of Eastside People was the structure of our organization and how to make ourselves more attractive and viable and for investment. And so what we're doing, we're currently a social enterprise, but we're looking at, or we've started creating a charity or a CIO so that we can have a clear distinction between the two, but the two work quite well with each other. We're quite different because we don't want to always ask for a handout. That doesn't sit well with me as a person, and I see the value in what we're doing. And we also want to have the two organizations so that we can encourage our residents to start up little businesses where we act as the investor in them and we share the results of that. And that's a bit more difficult to do with the charity, but the charity allows us to asset lock and protect those assets so that investors know that it's not going to be used in any unscrupulous manner.
Great. And I guess just to finish off, it'd be interesting to hear from you if you've got any top tips for others that are thinking about taking on repayable finance and going on the journey.
Yeah, so I would say start the journey. Have the conversations if you are thinking about it. Propose your models because it was really helpful to have that critical friend through Big Issue. Big Issue was wonderful in saying, okay, your model is totally different. Nothing like this exists. They heard us out, and after seeing what we're doing, they gave us validation, which was really wonderful. Having external people who are in that sphere validating your model, picking out any things that they think might be weaknesses, but helping you to overcome those has been extremely valuable to us. Having a look at our business from a different level, from an outside perspective, from an investor's perspective, has also been really, really helpful. So I think to anyone thinking about this, I think to Lloyd's getting into this area, looking at some of the stuff that Big Issue does and how they do it, I just think it's a wonderful opportunity and really great to hear of such an established bank looking to do more of this. So yeah, and if anyone wants to ask any questions or come and see what we're doing up in Northampton, you're more than welcome.
Great. And I think you've very neatly led me on to the next bit, which is, again, we're going to just pause here and take any more questions. I'm sure some people must have some questions for you, Darren, but also any other questions for our other panelists as well. So I'm going to hand over to Tracy again, who has just been keeping one eye on the questions, and see if we've got anything else. Thank you. Tracy, are you there?
Yes, no, I've muted myself. I'm waiting for people just to respond to Darren. There is a question I'll come back to at the end, just for Homewards, which will probably be a good wrap up. I had a question, Darren. Annie and Linda both mentioned impact measurement and kind of being able to demonstrate your impact to investors, this would apply more widely, I'm sure, than just big issue. And I know from my own experience, I found that quite challenging. Where were you on that when you started? Kind of what journey have you had to go on that? Because obviously you've got to be able to demonstrate this impact, haven't you? So it's obvious you're doing brilliant things, but actually you have to be able to do a bit better than that. So evidencing it, which is a challenge.
Yeah. Well, it's been quite interesting is that the financial impact has been worked out for us by the council, who looked at our model and said, okay, let's see what you're doing. And they compared it to their own models. And they found that over a 1.5-year period, if they scaled this up just to like 15 care leavers, they'd be saving themselves about 1.5 million a year. And which seems crazy to us because it would be far more income and for them to pay us for that service. In terms of measuring impact, we could always be much better. We don't really have very formalized systems. I've got a very basic folder system where I'm capturing these, and we're hoping to work with the local university and have people come in to assist us with that. They were asking for £5,000, which was really small, is too much money for us to be spending right now. So we're carrying on with the work and we keep capturing the data, and hopefully we can get some third-party evaluation at some stage soon.
Yeah, I think the key to it is having data that you're capturing anyway, isn't it, rather than it having to be a job of work. But I think the teams within the funders, and I think what we found really helpful was them being able to use that data elsewhere to have other conversations, be that for funding or otherwise, really. But I mean, it's quite a helpful discipline, isn't it? In some ways, a bit like the due diligence, but it's getting there in the framework, isn't it? I've had a message from Declan saying, "Brilliant initiative, Darren. Keen to reach out and have a conversation about your work model." So I'll connect you after the seminar.
Thank you. One of our biggest problems actually is that we seem to be too successful at the moment. Probation keeps lowering the risk of all the men that we're housing, which is wonderful. They keep getting jobs, and so I don't need to do as much work with them, which is also wonderful. But my big issue is the move on accommodation, which is still an issue because these guys still face the same barriers with trying to get credit references and all the rest. And so now my challenge is I'm having to take on the risk of being guarantor for them if I want them to move on. So that's a slightly different issue. So they've done all the work, they've got the jobs, they've reduced their risk, they're doing all these good things, but now I need to work on the move on. And I think that's probably a challenge for a lot of housing providers.
Indeed. So just while we're waiting and seeing if anyone else would like to ask Darren anything before we close. Yeah, Glenn, completely understand your pressures, and but yeah, you'll have a conversation offline. So Blesson asks, and I think this is probably more for Homewards more generally. How will the local areas be notified about the availability of this funding? Who'll take the lead in each local area for managing and distributing this funding and progress and completion? And what will be the extent of Homewards' involvement in the local decision-making processes related to this funding? So I guess that's for you, Michael, really. I'm rattling through there a little bit. So I guess it's about communication, distribution of the funding, and also your kind of involvement in the actual decision-making.
Yeah, thanks, Tracy. So I think from a Royal Foundation perspective, we're not involved in the decision-making processes related to the funding. That's not kind of within our proposed jurisdiction. But as through the Homewards program in each of the locations, we've been working to proactively identify organisations that would be eligible and might be interested in accessing this funding and connecting them into the guys at Social and Sustainable Capital and Lloyds, who ultimately then will be managing that process. So it's not something that it's not a requirement necessarily for you to have to go through any members of staff at the Royal Foundation, if that's the question. I think there's an element of this where it's definitely worth at a location level talking to commissioners, whether that's your local authority, whether that's your health service, in relation to the revenue funding that you might be requiring in order to deliver the service in that model. It depends obviously on what your delivery model is. And I think the local delivery leads and other partners within the local coalitions would be happy to try and help facilitate and support that wherever we can.
And just to reiterate that in the contacts that you'll see at the end, the email address for inquiries about the Lloyds funding is there. So that should be clear. I haven't had any more questions for Darren. I don't know if any of the panelists have. We ought to give them the chance, I guess, before we finish. Fascinating story. Oh, Annie,
just a quick, very practical question in terms of your issues with the local authority at the minute. I guess, do you have an understanding of timeframes on that and kind of what that's going to look like? And are you going to explore other forms of finance in the meantime, or are you kind of going to wait and see how this plays out?
So yeah, it was only announced 2 weeks ago about that. I'm kind of doing a bit of both. I'm thinking if this doesn't go ahead with the local authority, there are actually some other opportunities, and it's a really exciting one is because I've got the issue about the cost of the properties, the difference between the 2,000 that we can get from big issue and the 3,000 marker. And needing at least a 15% deposit. There's a real opportunity, and I'd love other people to explore this as well with your local authorities, where you can look at unused bits of land or parcels of land from the local authority, and if they give that to your charity on a long lease, you can either remortgage on that and raise capital to build properties, etc. And it's a real opportunity for people who are struggling to get that first bit of finance, because then that land itself can act as your deposit, and then you can get investment. And that's where, when we're getting that, we can go to big issue and potentially get larger loans to build, and then we'd have our residents building further houses. And that's a beautiful cyclical model. So we're busy trying to work on that as the next phase if this one doesn't work out the way we hoped. Great question.
Brilliant. Yeah, that sounds a really interesting opportunity as well to explore sort of for the next phase. Well, I think it's probably then time to wrap up the webinar, and I just want to say an absolute massive thank you to all our panelists for sharing their insights, but also for their time. I think it's been really interesting to hear from all of you coming from different perspectives. So thanks so much. You've covered everything that I was hoping would be sort of drawn out through the session. So thanks so much for that. For everyone else that's still on, if you're interested to learn more, we've sort of pulled together a load of resources and also contacts for everybody that's been mentioned today. There's also a case study in there of another organisation that's successfully gone on this journey. So this will all be circulated as part of a slide pack afterwards. And again, as we said, the link to this webinar will be in there as well, and also available on Homewards and Eastside People's websites. And just the last thing to say, I suppose, if you've got any queries or questions, please do use our contact details and get directly in touch. We'd love to hear from you and be able to answer any of those questions. Thanks so much to everybody for giving us your time this morning, and have a great rest of the day.